Right, guys, thank you for being here still at this time, and welcome to the VC Perspectives panel. We have very esteemed guests here. I think they don't really need an introduction. They're among the best VCs in the space. Probably we're going to jump straight into it because we have only 40 minutes and a lot of questions. So maybe first, I hear that VCs are able to predict the future. So I'd love to know, how will the macroeconomic environment of 2025 impact the stablecoin market and its profitability? And I wonder if certain types of stablecoins are going to be more affected by these conditions, could be positively or negatively. And I'd love to start with Julien on this one.
Yeah, for sure. Well, I think the uncertainty of the macro economy landscape worldwide is adding a lot of pressure on stablecoin. Either the rates are staying high, and like issuer of stablecoin might actually profits more and continue to profits. Like for example, last year, I think it's Tether made 7.7 billion net profits in Q3, which is quite amazing as a business for a small team. And if inflation stay high, so we continue to see more adoption in stablecoin, like issuer of stablecoin. If inflation or rates are going down, it will probably get more advantage for DeFi, algorithmic stablecoin or yield-based stablecoin. But yeah, no one can really predict what's going to happen. But for sure, it's going to be an interesting year in the stablecoin economy.
What about you?
Yeah. So I think that incumbent stablecoins such as, run by Circle and Tether, where the balance sheets are really driven by the yield that they absorb, they will be affected given that there's probably still 2 rate cuts ahead of us in this year. But they also have stockpiles in a way that some of the emerging stablecoins that are just passing through this T-bill yield, which will also be affected by rate cuts, do not. So while they will be affected, I don't think as severely. And probably the other dynamic that plays into account is when rate cuts happen, people tend to go towards risk assets, and crypto is one of those risk assets, which overall increases activity in crypto, overall in stable coins. So what you lose maybe in like some NIM, you can still make up for in volume. But I think that there's a category of stablecoins that are actually poised to really benefit from this very explicitly, which are stablecoins that are driven by crypto native yield. So examples of this are like Athena and CAP, because if rate cuts increase volume and liquidity in crypto and just like a more bullish sentiment, these kind of stablecoins are going to just have a better offering to consumers. And I think they're going to be some of the winners as we go through rate cuts.
The other interesting dynamic, which I've been thinking about a little bit, is to Stuti's point, if you get demand for Bitcoin, which widens out the funding rate spreads and creates a higher sort of yield on the basis trade, which is obviously what Athena's running, and then obviously there's a kind of correlation between the amount of leverage in the system and the interest rates that OTC desks can get. It's all kind of connected. If that does happen, you'll see an effect where Compound and Aave, MakerDAO, et cetera, will raise interest rates. And so you could get supply, deposit rates on supply on Aave or Compound at, higher than kind of the SOFR, Fed rates. And so you could see inflows on that basis, right, where people are sort of driving into DeFi because the basis trade is pushing up deposit rates on Compound and Aave, and those are 6-7%. Yields at Fed funds is 3%. There's a spread there, and then that drives further demand. So it's all sort of an equilibrium dynamic and super connected. I think VCs sitting on a panel trying to predict interest rates is a bit of a fool's errand to begin with. I mean, if you look at rate cuts in the second half of last year, there were rate cuts at the Fed, and the actual interest rates on the market shot up because the market was saying that it was too premature to cut rates because there were still inflation risks. And so it's anybody's guess what'll happen with rates. I think we're in a world where stablecoin, TVL or AUM is going to continue to be added because there's demand for stablecoins. So whether interest rates are at 3% or 5%, like these are super wide margins for the issuers at the moment. And so I'm not really worried about the business models either way.
I think the reality is like stablecoins is the one area where whatever happens in macro, like it's going to be a lot fucking bigger next year.
Yeah, I totally agree.
So if we talk about predictions, if you remember last year in November in Bangkok, so everybody was, very hyped about Donald Trump and that, he's going to save Web3, bring our wallets to the moon, everything was going to be amazing. So I wonder now, if you look at the last weeks, was the industry right to get this excited? And I think one thing I'd love to touch on, there is this thing called the Genius Act, which is kind of new. And I'd love if you, maybe Rob, if you can explain a bit what it is and how it's going to impact the stablecoin industry.
Yeah, so two parts of that question. I'll start with the Genius Act part, and then I'll maybe take the broader question. But Genius Act, very simply, just puts a kind of framework around how to think about specifically payments stablecoins. So payment stablecoins are the things that we know or we define as things like Tether and Circle, one-to-one backed, have treasury reserves, et cetera. It explicitly does not talk about things that use what the MiCA would call asset reference tokens. So things like Athena would be an asset reference token. It references some other asset. And it specifically does not talk about algorithmic stablecoins. There is a competing bill in the House that came out, and these two things are going to have to be reconciled, that did try to put a moratorium or not allow for new algorithmic stablecoins over the next couple of years. The lobbyists for the industry are all trying to work to get that language taken out right now, and hopefully it will be. Regardless of whether that happens or not, there will likely not be a, call it an outline of things that already exist. So we'll just try to not allow, anybody in the US to access a new algorithmic stablecoin. And it will not allow anybody in the US to access a, call it asset referenced stablecoin. What mostly it looks like, though, and I guess kind of from a broader perspective, is that now we will have a form of regulation and a form of and a way to go and get regulated and a form of rules around that for banks and asset managers and anyone in financial services in the U.S. to access U.S. dollar stablecoins, to potentially issue U.S. dollar stablecoins, and to engage with circles of the world. I think to your broader point around and kind of what this highlights is that there is now actually a interest and a willingness at the legislature and at the administration to engage with the industry on things like this. And that is undoubtedly positive. I think what is also undoubtedly positive is that there's no longer the SEC trying to regulate by enforcement at Uniswap or at Coinbase or at any of these other places. All of those things are true. The administration has clearly been good from that perspective for the industry. Now, prices have not been, or prices overran where they should have been in November. I think that's pretty clearly true. I was saying that back, months ago. But the market expected there to be just kind of like a flip the switch and like, holy shit, like everyone is doing crypto, like it doesn't matter, about anything else, whether it's, the infrastructure or compliance or whatever else. And that was clearly not going to be true. It clearly need longer amounts of time to think about a strategic Bitcoin reserve, to think about a market structure bill. The administration didn't do us any favors by launching a meme coin. And that sucked a lot of liquidity out of the market and has made the issue more partisan. And what has always been true of Trump administrations is that long volatility is probably the main trade, because there is just volatility in the way that he runs any of his businesses or the country. But clearly there's an underlying or an idiosyncratic set of things happening that are good for crypto and are great for stablecoins.
Yeah. I think the fact that this is even a question like that, were we wrong to be excited about Trump is actually like the other side of this is actually just reflecting like a 30-day kind of trailing average of trader sentiment and not necessarily fundamentals in the industry. So I think maybe if you go on Twitter in the last 30 days, like, price action is not great. But if you compare it to like where we were a year ago or even 2 years ago, we're in a much better place. Like as a country, I think the administration is doing far more than previous administrations as well. We've ended Operation Choke Point 2.0. Banks are in a better place to work with crypto companies, and that has significant trickle-down effects in terms of behaving as better on-ramps and off-ramps to crypto companies and to individuals. as Rob mentioned, fintech, DeFi, and CeFi are going to see tailwinds from all these suits against Robinhood, Coinbase, and Uniswap being dropped. I think that there's amazing things happening at the moment. Trump coin, not great, but the sentiment on the other side of this question is trader sentiment, which is always a reflection of recent price action and not fundamentals.
I mean, I actually have a question. If anybody on the panel has actually read through the Genius Act,
Yeah, I read it.
figured you would have. One of the challenges with MiCA, and my understanding with respect to stablecoins, is particularly that it regulates stablecoin issuers like banks, which are subject to Basel III, which requires a set of sort of equity capital requirements, which actually makes it hard for stablecoins because
It's a huge drag on ROE for
Right.
Circle specifically, but if you're considered like basically too big to fail, you have to be
Yeah.
over a certain threshold.
And is that consistent in the Genius Act as the way they did it under MiCA?
So it's a little bit unclear what like the type of collateral and where you're going to have to hold it right now. It's still it's going to be defined by the regulators. What will probably be true is that it will be some sort of Basel III type like capital requirements. The problem with MiCA and the issue that I think Circle has there is that if you get big enough, 60% of your reserves have to go in a non-interest bearing account, which means 60% of the reserves have to earn zero. Right, which I don't think the U.S. regulators are going to require, because they'll view, if you know Basel at all, treasuries are a good form of equity essentially, and so I'm guessing that it'll be more around how you audit it, what the transparency looks like, than requiring people to earn zero yield in a bank account.
I also think there's like unknowns at the moment for the existing crypto native players and stablecoin players with respect to Trump, which is. And now there's more comfortability from big organizations, asset managers, banks to potentially launch stablecoins, to work with stablecoins. And you do kind of wonder, I think there was an announcement this morning that Citi is launching a stablecoin. I'd have to go back and check.
Bank of America.
Bank of America.
They just said they would get involved.
Okay. Anyways, so like if there's sort of from players with existing distribution, if there's inflows or sort of activity there, does that hurt Circle or Circle's business model or Tether's business model? I think there's some unknowns there for our industry, but I think it's undoubtedly good for the sort of broad growth of the ecosystem. But specific players could be challenged as we go forward in that world.
Stuti, you wanted to add something before we move on to the... No? All right, so we talked a bit about the big picture. Now I'd like to move on to the actual competitive landscape and the forces within the industry. And maybe my first question is, don't we have enough stablecoins already? Are there still ways to innovate and differentiate from the other stablecoins? Are there still profitable markets that are not yet served? Or maybe the game is actually not in stablecoin issuance, it's in other verticals, other functions within the stablecoin ecosystem. So basically, I'd love to know, what are you excited about in 2025? What do you want to see? Maybe Stuti, you can start.
Sure. So, I'll start with, how do I evaluate stablecoin projects as a VC? I don't want to create a lot of portfolio conflict, but I have invested in 4 different stablecoins, and I firmly believe that they are not sucking market share from each other. They're all offering something unique to the market, and one person could hold all 4 of them and benefit from all of these. So for this, I'll share what my evaluation framework is when I speak with a new project. So I evaluate projects kind of through 2 buckets. I have a bucket A where I'm like, okay, as a VC, where do I have asymmetric information on how a project has edge that maybe the general public doesn't have because we are still pre-launch? Some of these sources of edge are the team itself. It can be, what is their regulatory strategy and the connections they have? Do they have any kind of unique strategy or advantage for cost structure? And how are they thinking about token versus equity accrual? And then finally, what are their distribution strategies? So this is what I know before a project launches. Then I try to predict how would a smart consumer think about stablecoins? And this is my bucket B. And a couple of criteria that a smart consumer might include, I think the 2 most important would be, first, how composable is this stablecoin, since leverage is quite important, especially for DeFi natives. Secondly, what is the incentive engineering around it? So, what are the organic sources of yield, but maybe other kind of like onboarding, early mover type advantages. And then other kind of structural and design questions, like, what are the redemption mechanisms? What is the risk profile? very important. What is the use case? Like, really, what is the utility? Like, if I pull out all of the incentives, where can I actually use this? Yeah, these are just a couple of examples. And, what does the peg stability look like? So I look at bucket A and bucket B. I say, okay, this new stablecoin project I'm speaking to, does it have a set of unique advantages that other major stablecoins are not addressing? Looking at those unique advantages, I then ask myself, how much liquidity can actually form underneath these strengths? Because you could have a very unique stablecoin that would address a unique market segment, but if there's only like 10 people it's applicable to, it's just not interesting as a VC. So I'm looking for something where a deep well of liquidity can actually form. And then finally, with these things in mind, I ask myself, where is long-term value likely to accrue? Is it going to go to VCs or just to farmers? Since what I'm looking for is a project that has the ability to last for more than half a cycle or even just a cycle. With this framework, I've been able to identify a number of different stablecoins. So, like disclosures, some in our portfolio include Agora, Athena, Cap, and Usual. And I believe that all of them kind of, fit these bucket A and bucket B and have a deep well of liquidity that has already formed or will form underneath all of them in unique ways. In terms of all of these, the one that hasn't launched yet, so the one that I'm excited about, that the market has yet to validate is CAP. I think what's interesting that they're doing that I think a lot of stablecoins struggle to do is create moats around the underlying collateral. I think a lot of stablecoins end up being collateralized by fiat and fiat-like instruments because it is scalable and it's also easily accessible. But if you can find a way to juice a scalable amount of yield from collateral that others don't really have access to, that's hard to find. And I think CAP is doing this right now. Or that's what they're planning to launch with. And I think that's what Athena also launched with, which is what made us so bullish on them.
Thank you. Maybe, yeah, Julien.
Well, I think by order of magnitude, we've seen more attempts to build stablecoin failing than actually succeeding. So that's the reason why we need more initiative around stablecoin if they're all failing, or the success rate of adoption in stablecoin is very low. And we're talking about market cap of 200 billion, but of course, like centralized stablecoin solution have been the one being used, and also USD, US dollars version of stablecoin. But the world is not running around US dollars, or actually it is, but could be way different. So we have Argentina or Nigeria, and more countries are going away from the SWIFT payment system. I mean, it looks like. So I think there will be a lot more initiative around local stablecoin that can be backed by different type of asset. Could be like gold, or because the technology is evolving pretty fast with ZK, FHE, AI, computational power. So new form of stablecoin that could be backed by, for example, computational like AI type of things. I think people are starting to build those type of ideas. So we are seeing more and more stablecoin and different form of stablecoin that could be used and adopt in different form in different regions of the world. Because we need a euro stablecoin that is not backed by USD denominatory monetary policy type of things. And Japan also is trying to create a stablecoin. I think Société Générale, Crédit Agricole, all the major banks in Europe, they also advancing on the subject. And you also have the same in Asia. I think money is one of the biggest things that you can control, way bigger than war. So I don't think countries in the world will let US dollar be the dominant stablecoin, and we will have to fight for it. So we'll see more and more initiative in this sector.
Yeah. I want to disagree with that. I think that countries in the world are allowing the US dollar to be the dominant reserve currency. So I don't see why they would stop that in its tracks for stablecoins. I think it makes a ton of sense.
Well, because I think there will be a new form of money. I think the concept of money being USD, US dollar money, I think with the evolution of technology like AI, quantum computing, like all different type of things, I think that people are creating new form of money.
But then why would that create demand for a euro-backed or euro-pegged stablecoin versus a US dollar stablecoin?
No, I think well, it's kind of like a long-term future vision, but I feel like the form of monetary will be like, for example, a form of intelligence, a form of AI type of things. I know you don't necessarily are into the AI type of things, but I think there will be a new form of money, and I don't think why for example, why Bitcoin couldn't be the one that take over, for example, like in what the attempt of DAI and was actually pretty good and failed because of liquidity and adoptions. But I think that should be the type of initiative that DeFi and decentralization should be pushing for.
But if we remove the AI and so on from the discussion, is there a space? Why are all these stable coins USD denominated? Is there a market that could be profitable, sustainable for non-USD denominated stable coins?
Yeah, so it's interesting. I was just having this discussion with somebody else before I came up here. The reality is right now what we're seeing is people want dollars, right? This is true whether it's in stable coins or whether it's in just fiat. Globally, people want dollars. I think your point is that the countries don't necessarily want their constituents to have dollars, right? And of course, right, you control populations by monetary policy. It's one of the biggest forms of control, right? But what we've seen is today, a lot of the stablecoin rise, like Tether specifically, in emerging markets where, in the more centralized entities, has been regulatory arbitrage. It has been, I want access to something that is maybe outside of the tax system, that gives me access to the US dollar, that will protect me against an inflation hedge, that maybe I can buy US dollar goods, et cetera, right? But those people are primarily trying to flee a local currency or getting into something that they have demand for, which is the US dollar, and they believe is better than their local currency for some reason, whether it's usually not spending, usually it's savings and savings against some sort of, currency that they don't like. I think in terms of, okay, well, like people talk about bringing FX on chain. If we're going to have FX on chain, well, yeah, you do need, to be able to swap in and out of a euro or a GBP or whatever else. But what we've seen so far is we're actually seeing companies, one of my portfolio companies is now doing completely on-chain, bank-to-bank transactions where they're going, okay, Brazilian real in a bank, they're issuing a Brazilian real stablecoin, they're swapping it on-chain, they're issuing a European euro stablecoin, they're swapping into that, they're then swapping through SEPA Instant directly into a European bank account. That transaction is happening 10 minutes because there's a little bit of operational work that needs to be done there. It could happen less. And they can do that for 10 bips. They could charge 75 bips, still half of what Wise for Business is doing, right? But what's
the name of that company?
It's called Conduit. But what's happening there is that they're using these non-US dollar stablecoins, but nobody actually wants to stay in them. They're just being used as a form of transaction. And when people want to save, they still want to go back into US dollars. Now, okay, well, I mean, that is what is actually happening on chain. So
they're just using them like for settlement in their own infrastructure. People are not actually holding.
They're not actually holding them.
Alternative.
Right? And you can see this when you look at the issuance and the TVL and the AUM of these stablecoins by the different currencies. So they're de minimis and non-US dollars.
But you're talking about this.
If I can add something, like if we believe that the world is moving into those AI agents and form of like complete agent markets whatsoever. My question and what I've been saying is like, what's the incentive, economical viability for an AI agent to transact in US dollar? It could be like transacting into a new form of money, like as I mentioned before, computational power or new type of crypto like Bitcoin or whatsoever.
Are you imagining these agents are like completely just like let loose and that they're not within like very defined frameworks?
I mean, this is what people are starting to starting building, like Asian talking to each other, making arbitrary decisions based on certain features and criteria. So I'm asking myself, I'm not saying, of course, like it's countries worldwide, they don't necessarily want people to use US dollar because this is actually against their monetary power. But this is currently what's happening because maybe you don't have other form of alternatives. But if we're moving into this type of vision where everything is kind of AI control based, and I'm asking a question like, what's the incentive of economical value for an AI to start using such like this USD type of things.
I'm
It's-
definitely open-minded to the idea that you can have an alternate form of money in the world of AI and AI agents. I think like all evidence points to global reserve currencies recycling over centuries or really centuries. So I'm open-minded to it. I think Bitcoin is a great candidate. I think practically speaking, like money is in some ways in the future, just to speak to something we've been thinking about, like it's really what's most liquid at the point of exchange. And I think that's the reason Tether in particular has been so widely adopted, because it is liquid and available in emerging markets and other places. But if you think about what a blockchain does and what stablecoins do, is they convert cash in a bank account into a blockchain-based receipt of that cash in the bank account that could be traded to other people sent around the world, and then they recoup that cash in the bank account. I think this is going to happen over time to all assets, and historically, cash, dollars move faster than, say, giving somebody a U.S. Treasury or giving somebody a stock or giving somebody a bond. I think the way that blockchains work on a go-forward basis is that pretty much any asset that can be represented on chain can move as fast as dollars or can move as fast as cash. I do think that changes what money means, because people went to dollars because it was the easiest thing to get in and out of. And now I think money in the future looks more like whatever's the most liquid at the point of exchange. And you can hold whatever you're saving.
Like ETH.
Yeah, it could be ETH.
Should be ETH, actually.
Sure. ETH, whatever, Bitcoin. Like, I'm not here to speculate on.
I think we failed here, but that's true.
Maybe I would suggest to, now we took a step back again. We're again talking about the big picture, but you two haven't answered yet. What are you excited about in 2025? Like the opportunities, not in 10 years, but what is exciting now? What are you looking to invest in? Will or Rob, go ahead.
Yeah, I mean, I've been saying when I get this question, like FX on chain, in previous cases, we have a portfolio company that's working on that. I mean, look, if you just look at the numbers, 70% of global trade is priced in US dollars, 99.9% of global of stable coins are in US dollars. And so you either bet that that's going to hold true and US dollars are the dominant form of on-chain currency, or you bet that that's going to retrace a little bit and other forms of stable coins will come on chain. And I think then you'll have kind of robust FX markets that allow you to trade between stablecoins. I think that's an opportunity. Go ahead.
Do you think it's 70-30?
I don't have a bet on. It's somewhere. I think it's somewhere in between 70-30 and 99.9 and 0.1.
There's a big gap
right?
there.
Yeah. But I don't have to bet one way or the other at the moment. I don't think. What else in the stablecoin space? I really am enjoying some of the stuff that is happening in DeFi around stablecoins. I really like what Morpho's doing with some of the vaults that allow you to lend against yielding collateral. I'm hugely bullish generally on the work that Athena's done over the last year. I think Athena, they have a duty to protect consumers at the end of the day and create robust financial products. I think Guy's done a really excellent job in what could be an otherwise challenging or sketchy product. But leaving that aside, the core idea that you can put a trading strategy behind a dollar, right? And the outputs of the trading strategy, the yield that's produced by the trading strategy is actually something which can be represented as a rebasing token or a yield that's behind a dollar. I think is a really promising and interesting idea. Like if you look at Renaissance Technologies, one of the most successful and famous hedge funds in the world, they produce a repeatable kind of cash flow on an annual basis that for 2 or 3 decades totaled at north of 30% IRR. And you could think about representing that as a stable coin, right? And it's just your interest in Renaissance Technologies fund. Now, consumer SEC, onboarding of retail to hedge funds does not allow for that at all.
Security.
It's definitely security. There's no confusing yourself about that, but it does open, I think, the Overton window about what's possible. And so I'm excited about continuing to look at that kind of intersection of on-chain and the stablecoin world.
I think what's interesting here is we're using the word stablecoin to define like a lot of things.
Sure,
actually,
yeah. I don't mean
right?
to, yeah.
Yeah, well, no, I mean, the whole industry does it. It's not a specific point, right? But like, what you're talking about are, tokenized hedge fund products. We're talking about, tokenized yield. I think a bunch of us are investors in Athena up here. And so that is the stablecoin makes that product usable in DeFi, right? And what you're talking about is like, taking a Rentech position and you turning it into a stablecoin to make it usable within DeFi. But at the end of the day, that is a very different product than USDT, USDC, Agora, stuff like that, right?
Yeah.
And so like differentiating between those two, I think is really important when you think about, okay, well, what's interesting? Because if you're doing a centralized stablecoin today that you want to be regulated under MiCA or regulated under the Genius Act, and you want to be used in regulated financial institutions for movement of money and money flow, then if you're going to issue a token today, like you can't just be an issuer. You are too far behind, and this is my opinion, of course, but you need to make it usable. You need to dog food it. You need to build something that is more full stack, and you need to figure out if there's a way that you're going to have it on. You're going to have your own orchestration layer. You're going to have your own direct-to-consumer application. You're going to have, potentially your own chain that has specific properties that are really good for these, these different PSPs, et cetera, who want to operate there. Like that sort of like integrating the stack is a way to be an interesting or to really kind of dog food your own issuance today. If you're talking about savings products and DeFi products, there's a lot of white space to do really cool things there and within DeFi.
So earlier, Rob, you talked about conduit, and it triggered, a lot of a lot of passion in the audience. Earlier, there was Stripe on stage who talked about Bridge. You also have a portfolio company called Rail. Maybe, Will, can you explain a little bit these actors? Who are they? What do they do? What is kind of this new opportunity in the space?
Yeah, I think maybe one area of the market which we haven't covered too much, which is worth sharing with the audience, is it seems to be working, which is the use case of stablecoins for non-crypto businesses in payments. So if you want to move, if you're a business in Brazil or in Argentina, for example, and you need to pay a supplier of resources in China, it's actually at this point faster to do it using stablecoins on a blockchain on ramp. Take Argentinian pesos, convert into USDT, send USDT across the world. Somebody factors that out, and ultimately, I guess China's maybe, but let's say Thailand.
Hong Kong.
Yeah, Hong Kong, exactly. And then somebody factors it back out into the local currency. That's happening like way faster than the 3 to 4 business days on Swift. And it's really a market that's growing. I mean, the market size numbers are a little bit rough. I think at the end of last year, it was somewhere between 100 billion to 200 billion of payment flow for these kind of orchestration companies, as they're called, that are doing this. I think that market's growing at least 60 to 100% year over year from what I can see. So huge secular growth trend. And we find that super exciting. And what these orchestration companies really do is they connect the local fiat bank accounts to the blockchain world and then provide a suite of APIs that allow people, if you're a business, to move your Argentinian pesos and then out to, as Rob pointed out, Hong Kong dollars, or he mentioned, euros on SEPA really easily. You don't deal with the complexity of the blockchain. So it's this integration between the local fiat banking rails, and it's kind of messy, and you need bank relationships and licenses, and then you're kind of abstracting away the blockchain behind the scenes. That's a whole class of businesses that seem to be, doing quite well, and I think is part of the growth story of stablecoins and payments. So we continue to be excited about that. I don't know if others on the stage have, thoughts on those. I think maybe just to pose one of the open questions that we have is, what's the long-term moat around those businesses? What's the long-term business model? Can they really get to scale? But yeah, it's a fascinating category, and I think it's part of the stablecoin story at this point.
So the person who yelled in the audience still lies or no? Okay, no more lies. We're good. Okay, so we don't have much time, but I'd love to talk about go-to-market strategies. And Stuti, I know you have a great GTM framework that you share with your founders. Maybe we have a lot of founders or new, upcoming founders in the room. Can you maybe share some takeaways that could be interesting for them in a market that's increasingly saturated?
Yeah, absolutely. So I'm sure that you as founders, you're thinking very deeply around the design of your stablecoin. I think one premise of kind of this go-to-market guide that I have is that great design cannot outrun a bad go-to-market. But at the same time, a great go-to-market can't outrun bad design. And I think when it comes to stablecoins and DeFi, go-to-market is a part of the design. So that's kind of the first premise. I think the second premise is one way to measure the success of your go-to-market is your TVL growth, so the amount of value that people are depositing into your protocol. And so I have sort of this assumption or this flywheel that I believe drives TVL growth as your go-to-market is progressing through its different steps. And the idea here is that positive attention towards a protocol drives increased liquidity, and increased liquidity in your protocol drives positive attention, which then begets more liquidity, which then begets more attention. So this is the flywheel that increases TVL growth. And bad attention can decrease liquidity, and the whole thing can work backwards as well, like in the case of Terra Luna. But let's focus on the positive side of this. So I was trying to think, with a framework like this, how can I make this useful for founders to consider as they're kind of creating a go-to-market strategy? So ideally, you have something that's a bit of a chain reaction. So the earlier steps that you take in your go-to-market sort of create a chain reaction that compounds as you move forward. So the suggestion I have is, I call it the signal waterfall. I can maybe share it later or share it with the organizers and they can share it with you. But the idea is that there's 6 categories, and this is art, not science. You can pick your own, that you can walk through. So first you start with the philosopher builders. So this is kind of like the high priests or the public intellectuals of crypto. This is like a Vitalik or let's say Rune from MakerDAO or Arthur Hayes. And you get their buy-in. And this is getting one person's buy-in as opposed to starting with the general consumers where you have to boil the ocean and get millions of people's buy-in. So you get this one person's buy-in, and this then gives you leverage to go to your next category, which could be the VCs. So the VCs, they are supposed to underwrite their own conviction, right? But we can be influenced by the conviction of these public intellectuals as well. So they're the next people that can give you a sort of stamp of approval in your process as you're going to market, and also liquidity and validation. Then from there, you move on to DeFi builders. Since when you're building a stablecoin for DeFi, one of the most important things you need to do is have composability and enable leverage. So this is a way to also kind of pitch and get buy-in whether your idea and design is interesting for the community, and get those people on as angels and partners. This then enables an easier conversation to be had with institutions. So these are the centralized exchanges, and maybe even traditional institutions, such as your Franklin Templetons or your Fidelities. They are going to be powerful distribution partners for you. And now you're getting wider and wider, as you go down the funnel of your go-to-market. Following this, I suggest you go to the DeFi natives. Many would call them mercenary. I like to just call it paid advertising. Every industry has paid advertising. Every industry has subsidized incentives in early go-to-market. And I think it's okay in crypto that we have it too. We do it in the form of KOLs. Lately, I see it more in echo rounds. And these generations or these strategies tend to be generational. But we're kind of subsidizing like the onboarding of your early adopters. And then finally from there, we move to the general consumers. These general consumers are onboarding your protocol organically. They are going to stay without subsidized incentives, and they are going to be the ones that give your protocol monetary premium. They are there for the utility. And eventually, what every protocol should be aiming for is monetary premium. That comes from this final category. But I do know it's hard, as I said earlier, to go to that final category and try to boil the ocean. So I think thinking about go-to-market in a way that gives it a bit of structure, and as I said, creates a chain reaction across all the segments you want to go to, can be a powerful way to consider this.
Thank you. Maybe one last question. Since we're talking about go-to-market, we have to talk about points, right? And I want to ask you, do you believe in life after points? Is there a way to, build a sustainable business after a points campaign? And maybe, Rob, you want to start there? Or Julien?
There's definitely a way, and I'll let him go. But if that is your go-to-market, you're going to die, right? And we've seen that happen time and time again. Some of the ones we talked about up here, you're seeing that happen right now with the TVL bleeding out. PYUSD, for instance, I hope no one PayPal's in the room right now. Like they did the points thing with Solana Foundation and Camino. The second that went away, the TVL dropped by 50%. There has to be some other product yield there that people want and that allows for a use case in the future.
All right, we're running out of time. Do you guys want to add something? Guys and girls, do you want to add anything? All right, thank you very much. Very interesting. Guys, let's applaud them. Very nice.